Dzień dobry, Artur Wiśniewski, stockbroker.pl, Atlas ETF.pl. Witam Was serdecznie na Pasywnej Rewolucji i zapraszam na wywiad z Benem Felixem, autorem fenomenalnego kanału na YouTube, z którym porozmawiam o zdroworozsądkowym inwestowaniu z wykorzystaniem funduszy ETF z uwzględnieniem perspektywy polskiego inwestora. Zapraszam serdecznie. Hello, Ben. Welcome to our conference.
Thank you so much for inviting me.
I know, and many people know that you're a YouTube author, and you have recorded so many YouTube videos, great videos explaining how to invest and stuff. You have very many subscribers, and from these videos, we could hear that you also work for PWL Capital. So many people would ask the question if you are more like a YouTuber or you are an analyst, and how did it happen that an analyst started to record videos on YouTube? Was it your idea, your initiative, or maybe your company said, hey, maybe it could be a good idea to promote our company? So what was the story behind it?
Yeah, so my current title at PWL is head of research. So I kind of think about my YouTube channel and our podcast as well as an outlet to talk about the research that I'm doing anyway in my job at PWL. People often ask, how long does it take or how much time do you spend doing your videos and your podcast? And it's really hard to answer that question because most of the work is the research that I'm doing anyway for my job. So PWL is a wealth management firm in Canada. I've worked there for almost 10 years, just under 10 years now. And I started my YouTube channel 6 years ago. Yeah, and it was the company's idea. Financial services in Canada is from reading some of your notes, I think it's a lot like Poland actually, where we have a very small handful of extremely large, powerful banks, and so that makes it hard to compete on marketing through traditional advertising channels for a relatively small firm like PWL. We're an independent firm. We're not owned by a bank. So instead of trying to outspend the banks on marketing, which would be impossible, our approach has always been to provide valuable educational content. So we used to do that through blogging. And then about 7 years ago, the firm PWL launched an initiative to support people and employees at the firm that wanted to start YouTube channels as, again, just part of that content marketing concept. And so I was the last person at PWL to kind of sign up for that initiative. A bunch of people started channels before mine. But yeah, I eventually did start one, and I guess the rest is kind of history.
And what is PWL Capital profile? It's not a bank.
Yeah, we're strictly a wealth management firm. So we do financial planning. We manage investment portfolios using low-cost funds. Yeah, so purely wealth management, which I consider to be a combination of portfolio management and financial planning.
You said that the initiative to start this channel was that there are some problems in the financial market in Canada. You said, because we also spoke before, that there are some similarities between the financial market in Canada and Poland and the similar problems. In the United States, ETFs and index funds are very popular. We can even say that there is a passive revolution. They are so popular, and assets are growing so quickly. And in Poland, ETFs are not really popular yet. Just a few percent people have heard about it at all. And is Canada more like United States or more like Poland in terms of popularity of passively managed funds? And what are problems in Canada and how the financial market look like in Canada? In Poland, as I said, just a few percent heard about ETFs, and most people go to banks, buy investment products like actively managed funds, structured products, or investment insurance products.
Yeah, so Canada does sound, I mean, I'm not familiar with Poland's financial market at all, but from your description, it sounds a lot like Canada. We have these really really big banks. And you know, on one hand, our banking environment is probably good for financial stability in Canada. Like our banking system has been very resilient relative to our neighbor, the United States. So that's kind of good. But their dominance also makes innovation and competition a challenge for any new entrants. We do have a few smaller digital first banks that have emerged, but our big banks are just so big, and they do sell. I mean, structured notes, structured products are really good for banks. They're a good financing tool for banks, and we do see a lot of those being sold to Canadians. We've tried to educate people on that, but it's not always easy. And then we have a huge cohort of investors and investment dollars in high fee actively mutual funds that are sold by our banks. So that's, you know, I don't know how to solve that problem. I often think about it, but the people who watch my YouTube videos or listen to my podcast or read PWL's blog or whatever, they're not the kind of people that are investing in those types of funds, because those people they've got their head down, they're working a job or whatever. They've probably got, you know, kids, or they're thinking about their retirement, but they're not trying to learn about low cost index funds, because that's a relatively niche topic. And when you look at the assets in Canada, it's like, if you just look at the active passive split, so like the index fund, whether it's ETFs or mutual funds, the index fund versus active split, it's like 85% of investment assets are still in actively managed products. So it's a big problem in Canada. We have not, you know, in the US they're like 50% in passive, I think, but we're nowhere near that in Canada yet, and it's moving in the right direction, but it's moving slowly.
Yes, in the United States, half of the market is like ETFs, and the second half are index funds. In Poland, the proportions are completely different because we don't have too much access to index funds, so it's more or less ETFs. I mean, the passively managed market. And how does it look like in Canada? Do you invest more in index funds or ETFs? And where do you buy them? In Canada or maybe in USA?
Yeah. So we can't buy U.S. mutual funds in Canada. You can only buy U.S. mutual funds for the most part if you're resident in the U.S. So we can't do that. We can buy U.S. ETFs though, and so a lot of Canadians do that. There are some tax reasons where it actually makes more sense for a Canadian to own a U.S. listed ETF, just because of the way the tax treaty is set up. So there are like interesting nuances like that. But if you look at the investment dollars in Canada, the vast majority of them are still in mutual funds. ETFs are gaining market share, but they're gaining market share slowly. And again, I tie that back to our banking environment, where if you go into the bank, which is where a lot of people go to get investment advice, you're typically going to get sold a mutual fund as opposed to an ETF. So as much as people are getting more educated, and we're doing our part to educate people, I think the vast majority of people are still getting stuck in the traditional mutual funds.
We've already mentioned USA, I think twice or more, and because ETFs and index funds are mostly, this is the country where they are developed most, and they emerged as a tool to invest in a passive way, but later people discovered that they can also be used to invest in a more active way. On one hand, passive investing is simpler and less time consuming, which is very important if you work from 9 to 5, have kids, and have some sport, do some sports, and you simply may not find time to invest actively. But on the other hand, investing in passive way maybe not too intuitive, because it means that you should observe your capital melting during market declines, which may be quite stressful. And that's why active investing might be the answer to those who feel not comfortable, because active investing, directly speaking, may be more intuitive, because it often may mean that I react to the reality, to what is happening on the market, which can make us feel more safe. So what do you think about it, and what would you advise to people, which way to invest, more active or passive?
Yeah, I mean, it's definitely more intuitive to invest actively. I don't think that makes it right, though. I think if you look at the history of investing, the intuitive idea that people should be active is kind of how the whole field of investment management started, where that was sort of assumed to be the right thing to do. And it wasn't until the 1960s when Michael Jensen had a paper looking at, well, hey, we have this model for risk now. They'd gotten the capital asset pricing model. Prior to that, there was no way to evaluate whether an active manager was doing a good job or not relative to the risk that they were taking. And so when Jensen started looking at how active funds were performing, he found that they weren't actually doing it. They weren't actually delivering anything special after costs. So they were really just delivering returns commensurate with the risk that they were taking. And investors were paying a fee for, market exposure that you could get just by owning the index instead. So that research started to come out then. And then we started to see Vanguard developing index funds. And there was one institutional index fund that was created before Vanguard, before Bogle launched the first Vanguard fund, which was available to retail investors. But this is like relatively concentrated in academia and in people who think like academics or had roots in academia. It took many, many years for people to start, and even still, as we talked about earlier, a lot of people still aren't catching on. But it took many, many years for the idea of not trying to beat the market being kind of a good idea. So anyway, all that speaks, I think, to the what you mentioned about being active, being much more intuitive. It feels right. It's how things were done for many years, and it's taken a huge amount of academic research to get people to slowly change their minds. And we're still in the midst of, as you call it, a revolution, but it's many, many years in the making. Now, when you look at the data on ETFs, so we know that assets in ETFs have grown like crazy. Assets in passive investments have grown like crazy. But if you look at how they're being used, at least this is based on US data, a lot of the trading is active as opposed to people just buying and holding. So a lot of ETFs empirically are being used for active trading. Why is that happening? I think, it's back to the idea of what's intuitive. I think investors have a bias for action. They want to do something. If they see the market dropping, they want to do something. If they see an asset that's performing well, they want to buy it. They want to change what they're doing. So there's a bias for action. And then I think that there's also overconfidence. So investors have both this bias for action and they have overconfidence, and the combination is pretty dangerous, I think. The problem empirically is that more trading is typically associated with earning lower returns. So even if it feels good, we have this bias for action and we think that we're going to be able to do something good. If you just look at the data, more trading typically means lower returns, not higher. Probably the best thing for most investors to do is to pick a strategy that they can stick with, pick an asset allocation that they can stick with, and then remain disciplined as opposed to giving into that bias for action. I think a good check, a good thought experiment, if you feel like you can make a smart trade, if you see something happening and think, I can capture that upside or I can avoid that downside, it's always good to ask yourself who you're trading with, who's on the other side of the trade, and why do you think that you know more than them? Why do you think that they're going to give you alpha? Because nobody wants to give up alpha. So what makes you smarter? And that's just a good gut check, because people often think, I feel like I have an edge. I feel like I know something, but in most cases, you don't. And when you step back and just look at the data on individual investor performance, on active fund performance, on tactical fund performance, not a whole lot of people out there beating the market.
Actually, I think I'm an example of a person which you mentioned. I think I have a bias on being active. I started to invest in active way, and then the passive attitude appeared in my portfolio, but I still have some passive part. So I invest partly in a passive way and partly in an active way. And do you invest in completely passive way, or you also have some active component in your portfolio?
Yeah, it's a great question. Active and passive they're really tricky names. I think everything's active. So I mean, let's start there. Everything is active because even an index fund, which is typically what we would call passive, even an index fund contains active decisions. You have to decide how the index is going to be designed. You have to decide whether you're going to fully replicate or do a stratified sampling to replicate the index. All sorts of decisions like that. And you can even find like two, in Canada at least, two international developed market indexes can be materially different because, for example, FTSE and MSCI, they treat developed and emerging markets differently for designations of countries. So you can have different countries in an index with the same title. So either way, you're making active decisions about what gets included in an index. But there's a spectrum of active, and I would call the least active approach being market capitalization weighted index fund that you just buy and hold. That is as unactive as you can get, even though there's still some active decisions involved in building that product. And then on the other end is probably a highly concentrated, high turnover strategy that's trying to capture some alpha. And then between those two extremes, there's lots of different approaches to investing. So I personally am not on the furthest end of the least active end of the spectrum. I'm not just using market capitalization weighted index funds. What I use personally is the same as what we use at PWL, which is total market funds that tilt toward smaller and lower priced stocks. So they tilt towards small cap and value stocks. They also consider profitability. It's still a total market strategy. So if you compare my portfolio to a total market index fund, they're going to look, there's massive overlap. I'll say that. There's massive overlap. They overall look fairly similar, but I do own quite a bit more of the smallest and cheapest companies in the market, and I own quite a bit less of the largest and most expensive companies in the market. So that's active in the sense that it's different from market capitalization weights. It's still kind of passive though, because there's no market timing involved. There's no bottom-up fundamental analysis where I'm selecting which stocks I think are going to do well. But there is systematic overweighting toward the types of characteristics that empirically and theoretically have higher expected returns. So I'm somewhere in the middle, I guess.
You said a very interesting, and it was a good point that it's hard to say what actually is active and passive, whereas the border. So you said actually everything is active. And another problem is what to add to this long-term portfolio. The classic attitude is like add just stocks and bonds, like Warren Buffett said, when I die, he advised his wife to buy 90% S&P 500 and 10% bonds. And on the other hand, we have like Ray Dalio, who has stocks, bonds, and also commodities like gold. So who is the smarter guy, Ray Dalio or Warren Buffett? What would you say?
I'm personally not a fan of gold. Buffett's arguments that gold's not a productive asset are pretty good. I think gold is a very, it's got a lot of history. There's no question there, but it's a very empirical bet. It's a very empirical asset. And what I mean by empirical is that there's not a lot of really strong financial theory supporting its use in a portfolio other than the fact that we know what its historical returns have been. And I think the other important piece there is that gold returns kind of post 1974 is often what people look at in portfolio backtests. And gold returns over that period were incredible. I mean, and that was largely explained by one sub period within that period. But if you look at the very, very long history of gold, it's kind of been a 0% real return asset. Now, some people might hear that and say they like that. Some people might hear that and disagree with the data because gold prices were controlled through various periods in time. But anyway, my view on gold is that it doesn't have an expected return. And maybe if we really rely on historical data, we can say that it's got a 0% real expected return, just because that's what it's done in the past. But as a asset allocation decision, it's not something that we include in portfolios, and it's not something that I include personally. Now, all that being said, if someone wants to include 5% in gold in their asset allocation, it's not the end of the world. And I think a lot of people have very strong emotional or psychological reasons to own gold because it's viewed as an inflation hedge, even though empirically it's not, unless you've got an extremely long time horizon. So I'm not a fan personally, but I understand why some people do want to own some.
As you said, there can be different attitudes to how to build a portfolio. And if you live in the United States or in the Eurozone, you can generally more or less advise people, and people can follow these general rules and they will not hurt themselves using ETFs. But there are also countries like Poland, which have a little bit different perspective, especially because we don't have euro or dollar, but our currency is Polish zloty, which is it's a different story. It especially impacts investing in bonds, because if you want to invest in bonds, because of currencies, the investment is very volatile while it should be stable, but it's not. We don't have actually ETFs which are PLN hedged, so which is a problem. We can invest in Polish government bonds, but it means that we have credit risk. I mean, it's just like a single issuer. Maybe Poland is not going bankrupt now, but we never know. There were some examples in history where even big agencies didn't predict that a big company or big country defaults. Which is worse, credit risk or volatility? Should we invest in bonds and hedge, do the hedging ourselves, or maybe we should invest in bonds, in foreign bonds without hedging, or maybe invest in Polish government bonds?
Yeah. It's a tough question, which is of course why you're asking it. You don't want to ask me the easy questions, I know. I think we have to think about what is the purpose of bonds in a portfolio. They're typically in there to reduce volatility relative to local consumption. That's why people want to own bonds, because they want to have an asset in their portfolio that's going to be stable in terms of local consumption. Like you want to be able to use your bonds to buy groceries if you need to, for example. So I think having a volatile allocation to bonds probably doesn't make sense, which means unhedged international bonds is probably not the solution. Self-hedging, I don't know. I don't know what the infrastructure is like in Poland and how difficult or hard that would be. My guess is that that might be too challenging for most retail investors. But I'm not super confident on saying that. I don't know what systems are available. I think that the other problem with unhedged bonds is that you end up with bond expected returns, which are low, with stock-like volatility because of the currencies. So that's typically not something that makes sense. We don't use any unhedged bonds. There's a good paper by, there aren't many papers on currency hedging, like academic papers. John Campbell does have one though, and he does find what I just said, that you probably don't want to own international bonds that are unhedged. In Canada, we only recently started getting hedged global bond funds, hedged back to Canadian dollars. Prior to that, most people were just investing in Canadian bond funds. And I think even now still, and I know Canada's not Poland, I'm just giving the example. But even now still that we have global bond funds, I think most Canadians are still using Canadian bonds as opposed to global bonds hedged back to Canadian dollars. But the other thing that I would come back to is, what is the objective? So if the objective of a bond allocation is to decrease portfolio volatility measured in PLN, then local bonds are going to be the most sensible solution. And I know we're trading that off with credit risk. If the objective, and the next point I think speaks to the credit risk, if the objective is to hedge against falling purchasing power in the long run, so your PLN bonds are going to be less volatile day to day. But if you're thinking about the next 30 years, so you're worried about hedging against falling purchasing power, I think there's pretty good research suggesting that unhedged international stocks accomplish that better than bonds anyway. So if your objective is just to decrease volatility measured in PLN day to day and week to week, then local bonds seem sensible. Now I am saying this without super deep knowledge of Poland as a country or as a financial market. So take what I'm saying with a grain of salt here. Yeah.
If we talk about currencies, they impact bonds more than stocks. If we look on stocks, the story is different. I mean, history shows that it helps. I mean, the returns are slightly better with unhedged investments, and drawdowns are smaller. I mean, the volatility is smaller. So it helps. It's a good idea. But this is also, again, a history. We don't know what is going to happen in future. We have examples like Ukraine, where Ukrainian currency, hryvnia, has been dropping for many, many years. And on the other hand, we have Swiss franc, which compared to US dollar is getting stronger and stronger for many years. And how can we know if Polish zloty, our currency, is going to go in the direction of Ukrainian scenario or Swiss scenario?
Yeah, I can't predict that one. I don't know what the future is going to hold for any currency. I think currencies are
The question is, how many currencies should we have if we don't know the future?
Yeah. So I think that again, back to that John Campbell paper that I mentioned earlier, his paper does suggest that a fully currency hedged portfolio is probably not ideal for anybody, and that a partial hedge can make sense in some cases. But in that paper, they're looking at cross-country currency correlations. So, for example, when markets go down, Canadian dollars tend to depreciate against U.S. dollars. So U.S. dollars tend to increase in value. So for a Canadian, unhedged U.S. equities are a little bit less risky in drawdowns than hedged U.S. equities. So they look at a bunch of considerations like that for a bunch of different cross-country correlations, and they kind of suggest, based on the historical data, optimal hedges for various countries. But they didn't have Poland in there. They did have a Euro land, they called it, geography. And but I think main takeaways from that paper are that fully hedging typically doesn't make sense. Partial hedging makes sense in more cases, and there's probably a theoretically optimal hedge, at least based on historical data, for any given country. But like you said, we don't know what the future looks like. And currencies are really tricky because they don't have expected returns like stocks and bonds. Like, we can say with some degree of certainty that stocks have higher expected returns than bonds. That's reasonable enough to say. But to take two currencies and say, I think this one's going to perform better over the next 30 years than that one, that's a little bit trickier. And then even more so, predicting future currency correlations, I think, is really tough. So I think the optimal hedging strategy is pretty subjective. It's going to be highly sensitive to the assumptions that you make about future currency performance and future cross-currency correlations. What we do at PWL, I can tell you that, we do a partial currency hedge. We also have a home bias to Canadian stocks, but we partially hedge foreign currencies, and we don't know what's optimal. And so because we don't know what's optimal, we kind of split the difference and do a little bit of hedging and a little bit of not. I think there are behavioral considerations in there too, where currency moves can be pretty significant over short periods of time, and that can cause behavioral problems for investors. So for example, it has happened in Canada where our currency appreciated significantly over a period of time relative to the US dollar. And so over that period, all of the Canadians who had a hedge in the portfolio felt pretty good. And then when the currency depreciates, they don't feel so good anymore. But at least a partial hedge dampens some of that currency-related volatility.
There are some or many analyses which are to convince us that investing in ETFs or index funds is really a good idea. And this analysis all often shows that costs are so important in the long term that if you invest in like 20 or 30 years, the capital in the end may be like twice bigger or twice or half smaller. And many people have that perspective. I mean, people invest for their retirement, but there are some people who are older and their perspective is shorter, like 3 years or 5 years, I don't know, 7, 10 years. So what strategy would you advise to those people whose perspective is shorter?
Yeah, this is a really common question. I think one thing to think about is that when you talk about years to retirement, that's not your time horizon for your assets. That's the time horizon until you have to start spending from your assets. But if you're spending whatever it is, 3% of your portfolio every year, starting in 5 years, your time horizon is not 5 years. Your time horizon is 5 years plus however long you expect to live in retirement. Yes, you're starting to draw the portfolio down, but unless you're taking huge portions of the asset out every year, I don't think that what happens in the first few years of retirement, for example, is that big of a deal. It matters, Don't get me wrong. But if you're taking small amounts of your portfolio out, I don't think it's as scary as people make it out to be. People do get nervous, though, switching from a saving mindset to a spending mindset. But I don't think there are actually major portfolio changes needed. And I think one of the reasons we don't see a whole lot of stuff being written about this is that there might not need to be any major changes that happen. We had a really interesting guest on our podcast, on the Rash Reminder podcast, not long ago, named Francisco Gomes, and his research is based on life cycle investing. So basically, how does savings and consumption and asset allocation change over the life cycle? So he's really looking at the question that you're asking: how should people's strategy change as they get older? And one of the things that he told us that really blew my mind is that traditionally, and everyone will be familiar with this concept, traditionally it's been suggested that your portfolio should follow a glide path where it gets more conservative as you get older and closer to retirement. But one of the things he said is that, well, it's true that if you just look at your human capital declining over time and turning into financial wealth, if we just isolate that, yes, it makes sense for your portfolio to get more conservative over time because your human capital is more like a bond. As that turns into financial capital, you want to decrease your allocation to stocks to maintain your overall risk exposure in the portfolio. But what he said that's really interesting is that wealthier households, so as you convert your human capital into financial capital, wealthier households empirically get less risk averse. When you take that into account, what he actually finds is that the optimal life cycle asset allocation is approximately flat, meaning that your portfolio doesn't actually change that much over the life cycle. Now that makes everyone's life a lot easier, right? Because we don't have to worry about a glide path. We don't have to worry about making changes near retirement. So, I mean, I like it for that reason, for simplicity. You just pick your long-term asset allocation, you stick with it over the life cycle. And then the other thing to think about is when we look at popular strategies that like having a cash bucket, for example, which is one of the things I think people are often thinking about when they ask questions like this. Empirically, and there's an interesting paper on this, empirically that's suboptimal. You make yourself worse off by cash bucketing than you would have if you just maintained your target asset allocation over the long run. So that's kind of how I think about it. No major changes need to be made. Now, one really important thing though, like I mentioned, spending 3% of the portfolio in my quick example there, it's really important for people to figure out how much and how to spend from their portfolio when they retire. Because like I said, if you spend 20% of your portfolio every year, then you're going to be extremely sensitive to the returns in each year. And it's kind of the safe withdrawal rate idea, which a lot of people are familiar with, but I think you can do it in more robust ways than just a safe withdrawal rate. But that piece, figuring out how much to spend and how your spending should change year to year based on how the portfolio is changing, that's probably more important than trying to optimize your retirement asset allocation. So stick with whatever asset allocation makes sense, but really focus on the spending strategy. That's probably going to be more useful and valuable. And I just one other point on that. I think in a lot of cases, people will try to solve the spending problem with asset allocation. So that might mean allocating toward dividend stocks or using covered calls or other strategies that produce income. I think solving the spending problem through asset allocation is usually suboptimal. So it's really make sure the portfolio is good, make sure you've got the good long-term asset allocation that you can stick with, and then take a financial planning approach as opposed to a portfolio approach to figuring out spending.
Thank you very much, Ben. Let's try to summarize what we have said in one sentence to make it like a kind of advice to people who watched us. So you had better avoid buying complicated and expensive products in places like banks. You should really think of investing in ETFs or index funds if they are available to you. You should rather be passive. Maybe you can be active, but it's often more worth to be less active, and try to keep it simple and don't make things too complicated.
Yep, that was a great summary. I agree with all of that.
Okay, thank you very much, Ben. It was a pleasure to host you.
Thanks so much for having me.
Bye.